If you hold silver, listen closely, because the most important shift in this market isn't a headline spike, it's a behavior change. And once behavior changes, the entire playbook changes. This is Money and Empires. Today's video. If you hold silver, this changes everything, Michael Oliver's latest warning. Here's the hook. Markets don't announce regime change with a press release. They reveal it through reactions. Traders watch candles, insiders watch how the market responds to pressure. Silver's response to pressure has been changing. For years, silver trained everyone to expect the same rhythm. Pullbacks last long, rallies fail, price drifts back into familiar zones. That created a reflex. Fear rallies, wait for deep dips, fade breakouts. But what if the rhythm changes? What if dips stop lasting? What if pullbacks that used to take months resolve in days? That doesn't guarantee a moonshot, but it does signal a different type of buyer showing up. Michael Oliver's framework is about structural momentum and long cycle behavior, not day-to-day noise. The core idea is simple. Price can stall for years while pressure builds underneath, and when momentum finally shifts, the market can reprice faster than the public expects. The first clue is rarely the breakout candle. The first clue is how it handles stress. Does it collapse on pressure, or does it absorb pressure and rebound faster than its own history? Silver matters because it has two identities. It's a monetary asset and an industrial input. That dual role is the engine of its volatility. In a purely speculative phase, silver behaves like a leveraged sentiment trade. In a necessity-driven phase, silver behaves like procurement, and procurement doesn't wait for perfect charts. It buys windows of availability. So what's the warning really saying? Not silver must go up tomorrow. The warning is that the character of demand may be shifting. When demand shifts from mostly speculative to partially strategic and operational, the market becomes less elastic. That means dips get bought faster. That means inventories and availability matter more. That means volatility can rise even inside a bullish structure, and it means old strategies that worked in a range market can fail in a repricing market. We also have to keep discipline. Silver has had false starts before. Compelling narratives have appeared before, then prices retraced. Technology can evolve. Substitution can slowly reduce intensity. Recycling can rise with price. Macro conditions can tighten in pressure metals. That's why we frame this as a probability map, not a prophecy. In this 5-part breakdown, we're answering one question. Has silver shifted from range behavior into repricing behavior? We'll do it by focusing on behavior signals, faster recoveries, physical vs paper frictions, relative strength versus gold, and the mechanics of futures and delivery when volatility rises. If you hold silver, this changes everything because your biggest risk becomes using an old playbook in a new regime. Part 2 builds the structural case, why long compression matters and why fast recoveries are meaningful. Part 3 explains the gold to silver relationship and why ratio compression can accelerate moves. Part 4 covers the market plumbing, why futures, deliveries, physical premiums, and visible inventories can diverge. Part 5 gives the endgame checklist, what to watch, what can invalidate this view, and how to think like a risk manager. Let S start with the most overlooked truth. You don't need the world to run out of silver for silver to reprice. You only need the marginal ounce to get harder to source at scale. Silver is not a massive market compared to global capital flows. When capital rotates into hard assets, even modest allocations can move silver disproportionately. And when industry is bidding at the same time, the bid becomes sticky. That's the setup. That's why the market's reaction to stress is the real story. Now let's build the case. Silver's long containment is not just a chart pattern, it's a psychological trap. It trained the market to expect failure at resistance and to expect time-consuming pullbacks. That training becomes dangerous when the regime changes, because everyone is positioned for the old rhythm while the market starts moving to a new rhythm. The best word for silver's last few decades is compression. Compression means fundamentals evolve while price fails to fully adjust. Industrial reliance grows. Technology embeds silver deeper into infrastructure. Monetary uncertainty cycles keep pushing investors toward tangible assets. Yet silver repeatedly snaps back into familiar ranges. That mismatch builds tension. Tension can build quietly for years, and release can be nonlinear. That means the market can shift from nothing happens to everything happens faster than most people can emotionally process. And the first tell isn't the breakout, it's pullback behavior. In a normal range market, pullbacks are slow because buyers are not urgent. They wait, they demand confirmation. Short-term traders also need time to reset after getting shaken out. But in a structural market, pullbacks can be fast because someone is using dips as procurement windows. They don't need perfect, they need exposure. They see temporary softness as an opportunity to secure positions before price reasserts. That's why fast recoveries matter. They suggest dips are being treated as restock, not risk-off. Restock behavior is different from speculative behavior. Speculators can leave. Operational and strategic demand doesn't disappear easily. Now layer in supply dynamics. Silver supply is structurally slow to respond. New production takes time and capital, and a large portion of silver is produced as a byproduct of other metals. That means silver supply does not automatically surge just because silver price rises. Recycling can increase with higher prices, but not instantly and not without limits. On the demand side, industrial usage is stubborn. Solar, electronics, electrical infrastructure, medical applications all rely on silver's properties. Substitution is possible in some areas, but it is slow, costly, and often constrained by engineering, certification, and performance requirements. So even without dramatic headlines, persistent supply tightness reduces flexibility. Flexibility is the shock absorber. When buffers thin, the market becomes more sensitive to incremental demand. That's why late cycle commodity moves feel violent. They aren't necessarily more emotional. They're less buffered. Do deficits automatically force higher prices? Not immediately. Inventories can absorb imbalances for long periods. But deficits do two key things. They thin the buffer and increase sensitivity. Then, when investment interest returns, price can move faster than expected because the cushion is gone. This is why structural momentum frameworks matter. When a market transitions from mean reversion to repricing, traditional overbought logic can fail. Indicators can stay extended while price continues higher because the driver isn't just sentiment, it's shifting structure. So the part 2 conclusion is simple. If pullbacks keep resolving faster than the past, the buyer base is changing. And if the buyer base is changing, the odds rise that the long compression phase is ending. That doesn't remove volatility, it changes what volatility means. Now we connect that to the most watched relationship in precious metals, gold versus silver. And one of the cleanest ways to understand silver AS potential regime shift is through its relationship to gold. Not because gold dictates silver, but because the gold to silver ratio captures relative strength across cycles. Silver is smaller and more volatile. So when capital flows into metals broadly, silver often moves more dramatically. Here's the key. The ratio doesn't move smoothly, it compresses in bursts. When markets get serious about hard assets, silver can outperform gold because the market is thinner and the incremental bid has outsized impact. That ratio compression can become an accelerant because it changes psychology and allocation models. Institutional frameworks that track relative performance start to notice silver catching strength, and when they rebalance, they can add fuel. But we stay disciplined. The ratio has produced false signals before. Apparent breakouts have reversed. That's why the value is not prediction, it's detection. When long-standing relationships begin behaving differently, it tells you the internal state of the market is changing. Now tie this back to the "this changes everything" message. If silver starts holding strength versus gold during pullbacks, that's a powerful signal. It suggests demand is not just chasing momentum, it's absorbing supply on weakness. When silver refuses to stay weak relative to gold, that can mark the early phase of a repricing regime. There's another reason the ratio matters. Gold is primarily monetary. Silver is monetary and industrial. In early phases of monetary stress, gold often leads as the clean hedge. Then, if the cycle deepens and broad commodity interest rises, silver can catch up aggressively because its market is smaller and because industrial demand provides a second engine. This is where Michael Oliver-style analysis tends to focus: structural momentum plus relative strength. If both begin shifting together, that's when analysts start calling it a regime change. They're not saying no pullbacks, they're saying the pullbacks may be shallower and shorter than the public expects. Now add a practical reality. Many market participants use silver as a high beta expression of the precious metals theme. That means when conviction rises, silver can see surges because it offers leverage to the narrative. But when the market is shifting from a range to a repricing environment, that leverage can become self-reinforcing. Rising price attracts attention. Attention attracts flows. Flows raise price. Price validates the story. That loop can run until liquidity or risk controls interrupt it. So what's the takeaway for holders? Watch how silver behaves relative to gold on stress days. If gold is flat and silver refuses to break down, that's strength. If gold dips and silver recovers faster, that's strength. If the ratio compresses and holds, that's structural confirmation. And if that confirmation is happening while physical frictions remain elevated, then the paper narrative loses authority. That brings us to the plumbing layer, how futures pricing, delivery behavior, physical premiums, and inventories can diverge in a regime shift. Most people think silver is one market. It isn't. It's layers. Futures are one layer, physical wholesale is another, retail fabricated products are another, vault custody is another, and in calm periods, these layers look aligned. In stress periods, they can diverge. Here's the clean idea. Futures are designed for price discovery and risk transfer, not necessarily to reflect immediate physical tightness. When the market is healthy, that's fine. Arbitrage keeps futures and physical connected. But when stress rises, the bridge clogs and divergences appear. A classic divergence is when screen prices soften, but physical premiums stay firm or even rise. That does not automatically mean shortage, but it does mean friction. Friction can be fabrication bottlenecks, distribution delays, credit tightening, or simply unwilling sellers at posted prices. In commodity markets, friction often shows up in delivery behavior before it shows up in headlines. Delivery matters because it reflects behavior, not opinions. Many traders roll contracts and never approach delivery. But when a higher share of participants move toward delivery, it implies they value access to material, not just exposure to price. Single data points can mislead, but sustained shifts in delivery patterns attract attention because they signal changing incentives. Inventory data adds another dimension. Visible inventories are only a subset of total above-ground silver, but they act as a barometer because they are tracked consistently over time. Only a portion of inventory is truly mobilizable on short notice. Some is owned by holders who won't sell, some is embedded in products, some is sitting in places where it won't come out without high premiums. So a decline in visible buffers can increase sensitivity even if the world has not run out. Now add volatility. Volatility is not just a symptom, it becomes a driver. When volatility rises, risk models tighten, exchanges adjust margins, clearing members reduce exposure, participants shrink position sizes, liquidity thins. And when liquidity thins, even modest order flow can cause outsized moves, which then feeds back into volatility. That loop can create fast rallies and sharp pullbacks without any immediate fundamental change. This is why regime shifts are confusing in real time. The market can look unstable while the structure is strengthening. It can also look strong while internal fragility rises. The solution is to watch the cross-layer signals: premiums, delivery behavior, inventory buffers, lead times, and the persistence of demand on pullbacks. So if you hold silver, Part 4's message is simple: don't judge the market by one layer. If futures are calm but physical is tight, that's a warning. If premiums stay elevated through pullbacks, that's a signal. If volatility rises and recoveries stay fast, that's a signal. Now we finish with a checklist and the risk-managed conclusion. Let's end like adults. The endgame is not a single price target. It's whether silver is transitioning from a range market into a repricing market. And the correct approach is not bravado, it's risk management. Here are the 3 scenarios you should keep in mind. Scenario 1, the system cools and reverts, premiums compress, availability improves, deliveries normalize, and silver returns to familiar behavior. This can happen if demand softens, liquidity tightens, or recycling and supply response increase enough to restore buffers. Scenario 2, managed fracture. The paper market keeps trading, but the physical market stays at persistent premiums and tighter terms. A 2-tier environment becomes normal. Scenario 3, acute repricing. The market crosses a threshold and gaps higher as paper chases physical reality, driven by persistent demand, thin buffers, and tightening liquidity. Now the checklist. What indicators matter most if you hold silver? 1. Pullback character. Are dips shallow and short or deep and slow? Fast recoveries are a structural clue. 2. Physical premiums and lead times. Do premiums stay firm during pullbacks? Do delivery windows remain stretched? That's friction. 3. Relative strength versus gold. Does silver hold strength on stress days? Does the ratio compress and hold? That's confirmation. 4. Delivery behavior and inventory buffers. Are visible buffers thinning? Are deliveries and physical interest persistent? That's behavior. 5. Volatility and liquidity conditions. Are margins tightening and liquidity thinning? That can create violent moves in both directions, but it often appears during transitions. Now, what can invalidate the bullish structural red? A real and sustained demand contraction, a meaningful technological substitution that reduces silver intensity faster than expected, a sharp macro tightening cycle that crushes commodity liquidity, a rapid increase in recycling flows that meaningfully restores buffers, and, most importantly, a change in behavior where pullbacks start lasting long again and rallies repeatedly fail in the old pattern. Finally, the biggest mistake holders make is using the wrong time horizon. If you're trading short-term, volatility will punish you if you don't respect it. If you're holding for structural reasons, you must accept that corrections can be brutal even in a bull regime. The goal is not to predict every move. The goal is to understand whether the regime is changing. So the conclusion is this: Michael Oliver, S. latest warning, is best understood as a regime alert, not a date call. Silver has spent decades in compression. If behavior continues to shift toward fast dip buying, relative strength, firm physical premiums, and persistent demand, then the probability rises that silver is exiting the old range playbook. And if you hold silver, that changes everything because the market stops rewarding the old reflex and starts rewarding positioning for a new phase.